recovering. So.
Thank you for that. Turning to some operational monetary policy issues, of course, all kinds of market people and reporters would love to ask you about negative rates.
Mm-hmm.
I would like, before getting what I'm sure will be your answer on that, I would like to ask a little more deeply about the thinking behind negative rates in the U.S. current context. So one way of looking at it is, of course, that QE and rate cuts are essentially substitutes. And so that if you can do more QE or all these various credit facilities and interventions, the 4 buckets that you listed, you could always scale that up and not bother with negative rates, which may have negative political effects as well as economic effects. A flip side is that on the other side, there are people who argue negative rates have a particular use in terms of currency valuation, but also, as my colleagues Olivier Jean and Joseph Gagnon have argued, it might enable more QE because it gives you more space. Just broadly speaking, how do you feel about the arguments for and against negative rates in the U.S. at this point?
So, Adam, let me start by saying that the committee's view on negative rates really has not changed. This is not something that we're looking at. We chose not to implement negative rates during the global financial crisis and the recovery, and instead we relied, as you pointed out, on forward guidance and asset purchases when we were at near the zero bound. And we've said that we intend to continue relying on those tools which are tried and they are now a part of our toolkit. In fact, we revisited this at last October's, just way back in October, revisited this question, and the minutes said that all FOMC participants, and that's not a sentence you get to say very often, all FOMC participants currently did not, that judge that negative rates currently did not appear to be an attractive monetary policy tool in the United States. So I would say a couple of reasons behind that. One is we do feel that our tools work. The tools that we have used, forward guidance and asset purchases, work. We're now doing these 13.3 facilities. We think they work too. So we think we have a good toolkit and it works, and we have evidence that it works. And I think that's what we'll be using. Also, the evidence on the effectiveness of negative rates is very mixed. It's very mixed. There's no there are research that says that they've been effective. There are plenty of doubters. And the issue really is the concern over interrupting the intermediation process and reducing bank profitability, thereby reducing the availability of credit in the economy. So it's an unsettled area, I would call it. I know that there are fans of the policy, but for now it's not something that we're considering. We think we have a good toolkit, and that's the one we'll be using.
Delighted to hear you say that. Let me turn now to another question about your toolkit.